Hi everyone, my name is Dustin Miles. Super excited to have Jeremy Roll on the show today. Jeremy, I don't know, I've heard your name for a long time, and so I'm super excited to have you on. It was great to meet you at the Old Capitol event a few months ago, and so I guess without further ado, if you could kind of give an intro for everyone, and excited for you to be here.
Yeah, thanks so much for having me. And I've actually watched you post on LinkedIn for a long time and I actually love your perspective. And I'm not just saying that, trust me. And it was good meeting you at Old Capitol, where we shared the stage on some interesting questions.
Oh yeah, I
um,
forgot about that.
yeah. So my name's Jeremy Roll. I am originally from Montreal, Canada. Been in the US for about half my life. I live near Newport Beach in California. I spent many years in the corporate world. I also have an MBA from the Wharton School. But from an investing perspective, I've been an LP investor for, I guess it's actually almost next month will be 24 years.
Wow.
And full time, actually, God, the math's starting to actually getting harder and harder to do. Yeah, about 18 and a half years, almost 19
Wow.
years full time. So I have a lot of experience in different LP and in going investing into syndications. I tend to focus on cash flow. I'm a pretty low risk investor. Tend to be concerned about the economy and stock market and stuff at the moment. And I look for more predictable cash flow. I live off the cash flow. Been living off the cash flow for almost 2 decades. And what else? I'm very diversified and invest across a lot of different asset classes. My main focus is various different aspects of real estate, but also do some non-real estate as well, and just a handful of startups too.
Gotcha. Wow. Okay. Awesome. Well, sounds good. So, I guess going back, 24 years or almost 24 years at this point. So, I guess, how'd you get into the space? I mean, that
Yeah.
was I guess I don't know if I don't think I've met anyone that started that early. So,
Yeah. So, for anyone who's old enough on here listening, I was working at Disney headquarters, and the dot-com crash happened, and I was sick and tired of the stock market for two reasons, because I'm a pretty low risk guy. One is the volatility. I didn't. It's the wrong fit for me to watch my portfolio go up and down 30% in a year. Just the wrong fit.
yeah.
And then also the lack of predictability for my long-term retirement account was the biggest challenge for me. It was really the predictability because of all that volatility many decades down the road. So I started to look at different ways to invest. This is 2001, two. And then eventually I came across the concept of real estate and just more predictable, stabilized cash flow. So I started to dabble in syndications. I think it was in February of 2002. And
Wow.
yeah, and then spent a whole number of years learning and ended up, eventually rotating all my money from stocks and bonds into cash flow.
Wow. Okay. Got it. And kind of in that era, 2002, how did you hear about syndications? Did you go to, I don't even know if meetup.com was there. Did you go to a conference? Like what, obviously Facebook, maybe Facebook was just starting. So,
Yeah.
how'd you hear about this?
But yes, and it's a long time ago, so it's hard to remember. But you're making a good point about all this because it was very difficult to do that at the time. So first of
Mhm.
all, the public, the 506C structures that they allowed for you to publicly market to accredited investors did not exist, right?
Mhm.
So it was very hard to find opportunities. The internet barely existed. And Meetup.com had just started and was actually really the tool that I was using to find meetings. So
Oh, okay.
honestly, it was just lucky for me. I lived in Los Angeles at the time because there were a lot of meetings being posted on meetup.com, and that's how I was out finding them. And I had no kids. I wasn't married back then. And basically, I was going to an average of probably 2 to 3 meetings a week, educating myself and trying to network. It was a networking to find opportunities that was the really difficult and challenging part, as well as the learning, of course. So the whole landscape's different now, right? There were no podcasts, there was no YouTube videos. Um, I mean, there were no iPhones, there was no Android. Like it was totally different. So it
Mhm.
ended up being a lot more work to learn the space and a lot less people participating in the space, which made for a whole different experience back then.
Yeah. Wow. Okay. Yeah, that's awesome. So, you got educated. You were, I don't know, how many deals you looked at before you're like, okay, Here you go, take my money, type thing. But what that process look like for you? Obviously, you're new, you're trying to understand, but I mean, just speaking to you, you can tell you're very sharp. You went to the Wharton School, um, you know, uh, probably highly analytical. So what did you do to get comfortable enough to, hand over, a large, you're not buying just a $50 stock, you're handing
Right.
over, probably quite a bit of money. So, what was that process look like for you at the
Yeah,
time?
to be fair, I had a bit of a unique situation because um, when I started to look at the different paths to go down, I was talking to a lifelong friend of my brother's who used to live right
Uh-huh.
near us. And I've been known probably since I was 4 years old. And his
Oh,
father
wow.
had been syndicating at that point for a couple decades. So,
How
so,
cool. Okay.
so the great thing for me is that A, I knew I could trust them.
Mm-hmm.
B, I could kind of uniquely learn from them. I could really like actually get into learning much more from them than a typical investor would, right?
Yep.
So I started
Yep.
dabbling, and in fact, one of the disadvantages is that they were investing in Canada, where I was from. So I was having to invest outside of the U.S. dollar, which can be good or bad depending on which way the currency goes. Which frankly, the currency risk is not something I really like to have. But the education was fantastic, and I started to invest with them. And as I was investing with them and learning from them, and they happened to be focused mostly on retail and office and a little bit of industrial, okay?
Okay.
And that was just his focus for a couple of decades, right? So as I was learning those asset classes from them, I was learning the more traditional U.S. asset classes. I call it more of like apartments, et cetera, here in the U.S. by going to the meetings. So it was a little bit from both sides. But I did get lucky because I had that contact. Had I not had that
Yeah.
contact, I think it would have taken me a lot longer to kind of dabble in the water initially and get over the hump of giving a very large check to someone, to your point. Back then, by the way, for what it's worth, the minimum investment amounts were typically about 25,000. And in some cases, someone who was new may have to go as low as 10,000. Whereas
Okay.
now, it's probably at the beginning stage of 25,000, someone who's new, more of a 50,000, right? But that's what the numbers were
Mm-hmm.
back then.
Yeah, that's great. Yeah, I guess my situation was sort of similar. I invested passively, but I also was like, well, can I be a KP? And so I was trying because I wanted to learn. Because I from what I could tell, I knew this is what I wanted to do and all that. So but I was friends with the guy for a few years before I, invested with him. So that's super cool. And so so you invested some in Canada, and then when did how soon did you do anything in the US?
Yeah, well, what's funny is that it was a very slow process because I'm very, very conservative. So, the problem with the US is I started investing in Canada, dabbling into the different asset classes we talked about, office and industrial and retail.
Mhm.
And that was exclusively with that one sponsor. And I was learning. And the problem is that by 2005, I became 100% convinced that we were in a crazy housing bubble, right? Which was a few years early. And so I put the brakes on everything and essentially, was very much on the sidelines between '05 and '08, which was an
Mm.
agonizing 3 year wait, like because everyone thought I was crazy saying that there was like a housing, until the end. Yeah, and I was very young, so it was just really, really annoying.
Yeah.
Anyway, it's a very long stretch. So I actually don't, I have to go back and look. I actually don't know for sure what my first investment in the US was. It's not coming to mind for sure.
Hmm.
But I'm guessing it was probably in 2009 or later. Now, that's real
Okay.
estate investment. I was doing some other stuff with a friend of mine with web hosting servers and some other cash flow stuff that's non-real estate related prior to that in the 2000s. Um, but it took me a long time to get comfortable investing with a random person in the US, but a lot of it had to do with the market timing.
Gotcha. Okay. Super interesting. Okay. Got it. So you've done a lot of real estate. I think you'd mentioned some startups as well. So what are some other but you said it was a pretty wide variety of things that you've invested in. Can you kind of list off, just kind of curious what different
Sure.
things you
Yeah,
listed?
yeah. I've done, I mean, God, in this all this times over a couple of decades, I've done factoring, which is you're lending against accounts receivable financing, typically of large companies. I've done hard money lending on real estate, which is typically for first position loan for a flipper in a single family home.
Mhm.
I've done some ATM investing. I started investing in ATM machines in 2008. Had a very good run with one operator from 2008 to 2023 in LA. That was more niche, but it was great. I I mean, I'm in over 60 LLCs currently, and I've been over 200 total. So there's been
Oh
a
wow.
lot of things I've done.
Wow.
God, those are just the cash flowing things. Like, the non-cash flowing things, there's a much, much big, broader. And there's a lot, we can get into a lot of stuff if you want, but I'm kind of like, I'm hyper diversified because I do it full time. So if somebody
Mhm.
said to me I'm new, and I'm not a financial advisor or anything, but if somebody said I'm new, how many things should I be in? I'd be like maybe 10 or 20, right?
Yeah.
20 is
Yeah.
even, takes a while. But I'm in many just because I'm doing it full time. So because I'm in many, I have many different things that I can talk about.
Gotcha. Okay, interesting. In when you're looking, I'm sure it depends on the asset class and all that, because they're kind of all over the board. But I guess for one or two of them, is there what sort of threshold? Well, let's just start with multifamily. And I know we were talking beforehand that you've kind of maybe been on the sidelines for a little bit on multifamily. So you definitely look like a pretty smart guy about now. So, what are you looking for in a multifamily deal? Right now.
Right now. So, okay, we'll talk specific multifamily, and this is going to sound crazy to some people who are listening to this because it's going to go back a little. So, let's rewind all the way back to 2008, 9. Okay, we had a tremendous amount of single-family home foreclosures, which is unfortunate for millions of people in the U.S. That led to
Hmm.
a ton of demand for multifamily properties, right? People were either renting homes or, if they got foreclosed, they had to go live somewhere, right?
Yeah.
So there was a ton of demand on the investor side for multifamily between 2009 and 2013. And by the end of 2013, I was already uncomfortable with the pricing for multifamily. That's the part that's going to sound crazy, right? So
Mm-hmm.
as of 2013, I did not invest in a multifamily deal unless it was unique in some way, whether it was pricing or some circumstance or some niche. So between two, and I have invested in many multifamily deals since then, but so from 2013 to 17, it had to be some unique situation for pricing, right? 2017 to 20, I was very defensive because we had an inverted yield curve that to me meant we were going to have a recession at some point. And I'm still convinced that had there not been COVID and stimulus money printing, we would have had a recession. Most probably in 2020, it could have been 21, okay, just from
Yeah.
all the probability wise. So I was like literally lobbying my sponsors to sell. Between 2017 and 20, I was in over 30 sales and I was really pushing to sell. During that time, so as of 2017, the only multifamily, or since then, the only multifamily investing I've done, first of all, is fixed rate period in general. That's just my own. I
Mm-hmm.
typically target 10-year fixed rate. That's not changed throughout time because that's the most comfortable thing I look for in terms of predictable cash flow. That's part of it, right? For my profile. But the other thing is that I haven't done anything that hasn't been tax abated or low income housing tax credit since the end of 2016. And the reason is because those were defensive plays going into potential recessions where you're the lowest cost player on the block for that asset quality. And that's defensive, in recession. Plus, we can get into detail if you want, but in those sectors, there's usually an advantage in terms of cap rate and or some type of tax component where you may have more positive leverage than a typical deal, right? Because things were very expensive then. Since 2020, I've been in the exact same framework for multifamily. So I've actually invested in numerous multifamily deals since 2020. They've all fallen under one of those two camps with fixed rate loans. When I say I'm on the sidelines, I am on the sidelines, relatively speaking, but I'm not doing no investing, but just very few and far between. For multifamily specifically, I've been very defensive since 2013. It started, 2017 became even more so, 2020 really most defensive possible.
Hmm. Gotcha. Okay. Interesting. And you just to clarify, so you said so fixed rate debt, and then you want something with some sort of tax abatement play. Is that
Yeah,
what I heard?
either tax abatement or low income housing tax credit, just
Okay.
because I think it increases the probability of both cash flow coming in general, but also when you're having hard times like a recession, you're the lowest cost place on the block potentially. You're better positioned to have less erosion of income potentially, right, on average,
Yep.
and the predictability of demand is higher because of that.
Yeah, 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 exactly. And then another thing that I guess, yeah, maybe didn't, yeah, I'm sure you've thought of this, but didn't touch on was the fact that, yeah, I mean, it's your largest expense, at least in Texas. And
Oh,
so,
100%. Yes.
yeah, so if you can take that variable
Yeah.
off the table, I mean, that's huge.
In Texas, when I've been in some of those deals, when you remove, you abate the majority, not like the equivalent majority of taxes, you're literally removing roughly 40% of the expenses.
Yeah. 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 So it's just, I just, my background's in engineering. So if you just, not to sound nerdy or whatever, but if you kind of look at an equation, you're like, oh, one variable's off the table. Perfect. It just,
Yes.
increases, the odds of winning. So,
But I would say this though, if you get into a deal that is what I call a market rate deal to start, maybe a little below market rents truly, and then you convert it to tax abated at closing. And so
yeah.
imagine buying a deal and then you're converting it to tax abated at closing and you're eliminating 40% of the expenses at closing. Imagine the amount of positive leverage you're creating right at the beginning. What I like to call without operational risk, which is not totally true because you have to remain in compliance, but it's
Yep.
mostly true. And if you get into the right profile where rents are actually below market rate, you don't have to actually reduce rents to conform to the tax abated rent requirements for the units that are income restricted. So you actually don't take a reduction in revenue. You do going forward to an extent, like versus potential revenue, because some of the units are going to be income restricted and stuff, and then lower rents. But the point being is that you can reduce expense without reducing revenues and create a huge positive leverage gap, which is what one of the reasons why it's been really attractive to me, even in the face in 2020, 21, 22, with negative leverage turned into positive, extreme positive leverage, or extreme is just more, it's the wrong word, but a lot of positive leverage, which is nice.
Yeah, yeah. So, just to not to dive too much into the details and all that,
Yeah.
but what sort of positive leverage are you looking for,
Mhm.
or extreme, or what is
Well,
that?
yeah, extreme is the wrong word. It just compared
Yeah,
to what we are seeing. So the way my
yeah,
brain works to try to protect myself is I'm just try to be very objective and analytical. So if you look at
Mhm.
historical, if you're looking at a Class B property in kind of an A minus or B market in Texas, for example, just to keep it simple, as an investor, you should expect to be able to get 125 to 200 basis points, call it 150 basis points. Okay.
Mm.
That means that is the positive leverage you should be getting in exchange for the risk you're taking,
Yep,
right? So if you're getting less, you're theoretically taking on more risk for the equivalent amount of reward and vice versa, right?
yep.
So all I'm looking for is getting back to the mean. And
Mm.
so that to me is the guiding light of like, is it too expensive to invest today or not? Right? And that's relative to the cost of capital. That's all that means, right?
Mm.
So the problem I'm having right now is that we have been in negative leverage in 2021, 22. We're going to
Mhm.
positive leverage and at a little bit of positive leverage now for the most part, but not at the mean. And that means that as an investor, if you're not getting that mean amount of positive leverage, you're theoretically taking on lower return for a similar amount of risk that you normally would have to. And I
Yep.
think we're still there at the moment. Hopefully
Yeah.
that'll change.
Yeah. Yeah. Well, what's interesting, not to give away strategies or whatever, but what's pretty interesting right now is so we've been looking at HUD assumptions, especially
Mhm.
those assumptions with really low interest rates. We're like,
Right.
oh man, look at that positive leverage, and so that's something that we've been looking at, or like you mentioned, we've done some tax abatement stuff. So we've been able to and we're looking at new deals to where kind of what you're talking about, to where we've built some relationships with some of these housing authorities to where we can buy at market rate and then shift over to that tax abatement. I like that quite a bit too. But in terms of just different sponsors that you've worked with and all that, are there what sort of characteristics are you looking for on that side of things, more in operations and communication and all that good stuff?
Yeah. So I'll start off by saying that it's going to be really complicated. And I say it's going to be, once I get really back into things where I feel like the pricing is there and the cost of capital versus the positive leverage is there this time around, because um, figuring out who is having challenges that maybe they may be distracted by. Another thing that I learned last time is I invested with a sponsor in 2008 in January. in the student housing deal. And we could talk about that because I actually anticipate a recession, but students go back to school. I being a perfect thesis about like it being 100% occupied the whole time throughout the recession.
Hmm.
And what happened to that sponsor is that they got foreclosed once. And because of that, their cost of capital went up for every deal they were doing after that for a period of time, right? And a
Hmm.
lot of investors probably haven't thought about that. But all of a sudden, you may be investing with a sponsor because they had one foreclosure who has a higher cost of capital that's impacting your capital stack directly. And so you're taking on a lower return for the same amount of risk versus investing with someone else, for example. So there's going to be a lot to consider and try to really parse through to figure out, am I investing with someone who's caught up in some challenges or not? How distracted will they be? And by the way, like I always tell people, the let's say over the past few years, the more deals somebody did that I wouldn't go near because we just don't mesh in terms of opinion about business plan or timing or what it could even just be risk level. The less likely it is that I'll ever invest with them because we're not seeing eye to eye in terms of which is what we're looking for, which is nothing wrong with, right? There's a thousand ways to invest. None of them are
Yeah.
necessarily wrong. So my concern is that there's been a lot that's happened that I haven't seen eye to eye with that I sat on the sidelines for, and I'm going to have to try to find the sponsors who are actually not doing much or
Mm.
doing the type of stuff we're talking about, right?
Yeah.
And that's going to be
Yeah.
difficult too. So it's going to be hard. I think it's going to be hard. And as you know, there's been a ton of carnage in the space, both on the LP and GP side, and that's going to make it hard too because there's just less volume of people to talk to on the LP side and less GPs to talk to as well.
Yep.
Now, um, directly answering your question, I prefer someone who's vertically integrated, so then has property management and other control over other things too. It's not a total requirement, but it's rare that I invest in somebody who's using third-party property managers because I feel like, you're betting on another company that's you can't necessarily due diligence as easily. And frankly, even if you did, who knows exactly how much attention they're going to pay to your property versus the other parts of the portfolio they're managing. I'm referring to the external property manager. So that's one big, you know, strong, not a must-have, but like a very strong preference, I suppose.
Hmm.
From a reporting perspective, I have no issue with someone who's reporting quarterly. What I will say is that I don't have like a very specific answer to that. What I do is that I will request a sample recent quarterly report, even if they have to redact it, and I'll just assess whether the level of detail they're providing is okay to me or not.
Mm.
Um, I'd say one of the biggest challenges I have sometimes is that I prefer someone to be reporting on actuals versus pro forma. Like, here's the
Hmm.
check you got. Here was the pro forma for, year two, quarter three. But what ends up happening is a lot of the time the sponsors are reporting based on budget for the year, which I totally
Mm.
understand because from their perspective, things change all the time and they're constantly tweaking and pivoting to conform to today's realities, right? So
Right.
I have a preference for that. It's not a requirement, but if I had a choice, I'd like to see it against actual pro forma, which is the initial expectations I had, as a side note. But I do think it's really important, like for anyone who's relatively new, please do yourself a favor and make sure you are reviewing sample reports from a sponsor before investing with them, because once you give your money to them, you can't just get out. And then if you don't like what you're seeing as far as that level of detail, it's too late. But I find a lot of people don't ask for a sample quarterly report in advance. They make some assumptions they're going to get certain data they may not get.
Yep. 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 Yeah, and I think especially for newer folks, they don't know what what to look for at all. They don't have a frame of reference of
Yeah.
what things should look like too. So and that can be a challenge.
Well,
So
yeah, and so one way to get around that or to solve that problem is, I used to call it opportunity exposure before internet and all this. That's how I used to
mm,
try to see all these opportunities and learn from reading them and actually
yeah.
compare them side by side. You can request quarterly reports, sample quarterly reports, and have quarterly report exposure and learn from those.
Mm.
And just if you look at 20 different quarterly reports from different operators for the same quarter of the year, you can see the differences and start to decide for
You're
yourself.
like,
What do I
yeah.
need and what don't I need? That's an easy way to do it. Or you can look at some books or courses that may help with that, in terms of suggestions.
Yeah, yeah, yeah. That's awesome. Yeah, it's a great idea. So, honestly, I don't think usually, yeah, I'm not asked that at all.
Wow.
Or very, very rarely am I asked that. So,
Yeah, and
anyways.
I'm not surprised because I know that's the case, having talked to a lot of investors. And then I also know that I hear complaints about the level of detail and reporting, yet most people don't think to ask in advance to be sure, you know?
Right, right, right. Yeah, yeah. So,
Another thing I just want to say, sorry to interrupt you, just
yeah, no,
while on
you're
the
good.
same topic, is
Yeah.
one of my pet peeves for it's literally been over 2 decades now is background checks.
Mm.
And I think no matter how much I talk about them, I don't know how much difference it's going to make. It seems like almost everybody doesn't do them. It drives me nuts. When I first started, this goes back to the internet, right? When I first started, um, you couldn't like sign up with what I call like kind of a second tier background check company that was somewhat reasonably priced and all the data wasn't available.
Yeah.
So I had to hire like a private investigator
Oh,
to,
wow.
that's how I did it. And those PIs had access to the higher level databases. So they would have that subscription and they would just charge you for running that report, handing it to you and interpreting it for you. Right. And that's actually how I
Wow.
learned. That's actually a great way to learn about how to interpret background checks as well. Not obvious.
Hmm.
Um, but for those of you out there, please, like it saved me several times for sure in having read some. And so please consider doing those. I also find just on the theme of what people don't do who are new, um, that's imperative. And yeah, it's not foolproof. The databases aren't perfect, but please try to do that. And if you don't know where to start or what to do, talk to some private investigators in your area and consider going down that route.
Yeah. Interesting. Okay. Yeah. I don't know. Maybe I've had my background checked and I didn't know it, but yeah, I haven't had that very often. That's for sure. So,
Look, for someone like you, as your name's not totally common, but it's also not completely uncommon. Normally,
hmm.
someone would need at least your address and or date of birth, and certainly city
Oh,
you're in
okay.
to make sure they're matching up the right Dustin Miles. Because
Okay.
you're probably not the only Dustin Miles in Texas,
Mm,
and
probably not.
yeah. So you know, if someone hasn't asked you that info, there's a chance that no one's ever run your background. You wouldn't know that they've run it, but still, there's a chance that someone hasn't run it.
Yeah, yeah, yeah. I've only a few times I can think of. So interesting. Yeah, yeah. Is so I guess I don't know if you have much of a crystal ball or not, but do you have any thoughts on just kind of the next 12 months or so? I don't know if you're going to NMHC or not, but
I'm not going to that conference. But let me just say this. I have no idea what's coming up in the next 12 months. No one really does.
yeah.
But from a probability perspective, here's what I can tell you. And this is good food for thought for everybody. Unemployment rate bottomed in April of 23 at 3.4%. We are currently, as of the December report, at 4.4%. And we have never, and we're up at 4.6% in November. Okay. So the data, because of November, December government shutdown, we still got to see January, February, and really, really understand where it's going to really kind of stabilize at. But we never had a period in the US history where we had a 100% basis point or more increase in unemployment rate where we haven't either been in a recession at the time or we're shortly into recession thereafter. So that's
Oh,
data point
interesting.
number one, right?
Okay.
Data point number two is that the stock market is currently at or near record highs amongst all the major ratios or indicators, right?
Hmm.
And so let's just, and also, we don't have the what reversion to the mean on positive leverage, right? For multifamily, say. So just stabilize multifamily, typical class B. That's what I was talking about before. So when you take all those together, I'm on the sidelines, right? I
Yep.
can't tell you
Yep.
what's going to happen. I can't tell you if it's going to be this year or not. But I will tell you this. I'll give you one more interesting data point. I was reading an article in August of 2025, and it talked about Palantir, which a lot of people have heard of. They're a tech company,
Hmm.
very big. And the PE ratio of Palantir, for those of you who understand stocks, in the article, I think was quoted at 640. And when I read the article, I thought it was a typo. I thought they actually added the zero and it was 64 because actually that's high, right?
Right. Right.
So I actually looked at it and I was like, "Oh my God, this is actually correct." So then I started tracking it every couple weeks, and then 2 weeks later it was 688. And so then I did some research and I found that Cisco, which was a very big networking
Yep.
gear company, was probably the most well-known beneficiary of like infrastructure for .com era. They peaked at 450 PE ratio in 1999. Okay, I
Oh
think
wow.
that was the year. So 457 was their peak PE ratio. So
Wow.
so in retro, like if we're talking in 2 or 3 years and there's been a bust in the stock market and a big crash, I'm going to say, of course, it was obvious. Palantir was 688, which was 50% higher than the biggest big cap tech stock from
Yep.
.com, right?
Yep.
So there's a lot of indicators, unfortunately, that are kind of in our face.
Yep.
And the risk reward right now is not a good equation for someone like me, which is why I'm on the sidelines.
Right. Right.
So
Gotcha.
that being said, I do think for multifamily in 2026, I think we're going to finally see some more supply of distress and or just general volume coming on the market. I think that will breed opportunities if you're into certain value add play or being able to invest in those types of things or those assumptions you're looking at, right, in those types of contexts. And so I think for certain investors, it might be an interesting time to take a look. For someone like me who invests in more stabilized stuff, I think it might be either this year or next year that some of the volume starts up. But I think I'm becoming a little bit more optimistic that we're finally getting to the point where I think some deals that make sense are going to start to happen after several years. So we'll see. But I think we require an end of cycle economic reset, recession, and stock
Mm.
market adjustment or crash to make all that happen, which is unfortunate. But I think that that is most likely the scenario that will happen.
Yeah, yeah, yeah. I've heard, in the news quite a bit about, AI bubble, and they're basically just kind of shuffling money from company to company, and so, anyways, but
Yep.
yeah, it'll be interesting, for sure. Just one little stat, maybe, and we may have actually heard this at the old Capital conference. Or if not, saw it somewhere else. I think it was Mark Allen had mentioned that Colliers had mentioned he thought peak foreclosures in DFW was going to happen sometime midsummer. So,
Mm.
anyways, so to kind of support some of what you were saying there, but well, cool. Is there, I guess I really appreciate your time. Is there anything, do you have anything that you want to give out, website, LinkedIn, whatever, as far as if you want people to contact you and all that, or anything you'd like to share?
Yeah, no. Thanks for everyone who listening. I just hope it was helpful for everybody. I have
Yeah.
nothing specific. I'll say that if anyone does want to reach out to me, happy to network or exchange ideas or whatnot. Doesn't matter. Happy to help any way I can. There's two easiest ways to reach me. I'd say the easiest to email me directly, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. You can also find me on LinkedIn. I will warn anybody that I don't check it often. If you message me or look to connect, it might take me a few weeks in that realm, but you will probably find me on there at least. And my name's not that common, so it's not that hard to find me there.
Yeah. Yeah. Cool. Awesome. Well, really appreciate your time, and great to finally meet you in person in October, and look forward to chatting again soon, Jeremy. Thank
Yeah,
you.
thanks. Thanks for having me on. Thanks for everyone who's still here listening. Hopefully it was helpful.
All right. Thanks, Jeremy. See ya. Bye.
Bye.